In trading, knowledge is power, and lack of knowledge in what you're doing can be costly, very costly. So you need a solid foundation of quality market education. Whether you're new to trading or a seasoned veteran looking to add advanced strategies to your arsenal, there's always something to learn and something to improve on. And now you can access the same knowledge that professional traders receive with Market Rebellion's Trading Education. I'm Bill Johnson, Head of Options Education here at Market Rebellion, and we've assembled a comprehensive curriculum based on decades of real trading experience, covering everything you need to know about trading options from beginner to advanced. We go way beyond the nuts and bolts of options theory to teach you how to apply specific trading strategies and the techniques needed to adapt your trades when markets shift. Regardless of your goals, you'll gain access to the education you need with easy-to-consume lessons so you can learn to trade with confidence, enhance your knowledge, and master the practical skills required for market success. So please join us for in-depth trading education only from Market Rebellion. Hey, good afternoon once again to all of our Market Rebels and YouTubers. It's that time again. It is 4 p.m. Eastern on Thursday, and that means it's time for Coach's Corner. And Stu, another big day today, huh? I think we were up. I didn't see the close, but I think you might have seen it up over 500 on the Dow, up almost
$564.
$564. Yeah. So what is that, about 2%, maybe a little shy?
1.75%. SPY was up just on about 1.9%, just under 2. Big day in the markets.
Big day. So one of the things that we like to do here on Coach's Corner is to bring to you various topics and options, but we try to get more into the things that you're not going to find anywhere else. We don't want to just show you what the break-even points are for a covered call and all the stuff you can find for free. We want to bring it from a professional trader's perspective. And of course, we have with us every week, Stu Dorfman, market maker on the PHLX.
Does that mean you call me professional, Bill? Because I resent that.
I resemble that remark. But you were on there for, if I remember, like a year or two, right?
On where?
On the Philly Exchange?
Yeah, times 30, man. Yeah,
times 30.
Under 30.
29 years. So if you want to know how professional traders see the market, this is your channel. And what we wanted to bring today, I always try to keep Stu a little bit in the dark and see if I can catch him off guard here. But I wanted to bring a very cool relationship with options that I think pretty much all the professional traders know, or the astute traders, and it will greatly help you for when you're looking through the quote board, trying to figure out what should this option be trading for, get kind of a rule of thumb. And it can also help you with some probabilities, help you to make better decisions. And we'll look at that at the end. But first, let's start off with our Chalk Talk. And this is our little thought question. If you're brand new, jot down your answer, and we'll come back and revisit it at the end. Okay. So here we go. We've got a stock trading for 100. We have volatility trading at 20%.
Mm-hmm.
Got interest rates at 0.
20%.
And the question for you, Stu, what's the 1-year $100 call worth? You're down there on the floor. You're looking at this. What's your gut instinct tell you that it should roughly be trading for? That's kind of what we're going for here.
You want me to give you the answer?
Yeah. You know what? Normally we don't do this. Normally you hold out to the end, but give people another 5 seconds to jot down their answer. And then I'd like to hear, again, kind of just a quick check in your mind. What do you think that option is trading for?
About $8.
About $8?
About $8, give or take.
That's a pretty good guess. Again, I always try to back him into a corner, but I'm not sure that this is how he got the answer, probably. But let's find out how you can figure out stuff like this and try to get a good feel for where option prices should be. And to do that, there's a very powerful relationship that is known, again, by professional traders. And it has to do with 40%.
And look, everyone, I didn't come up with that answer. It wasn't a guess. And I haven't memorized the matrices. Is that a word? Matrices. Matrices of 5,000 different stocks at the monies for a year. None of that happened. This is a general, I kind of see where Bill's going here. This is a general rule of thumb to take a look at pricing.
Yeah. And if you're going to look at a quote board, we have found so many times that new traders are just overwhelmed when they look at the options chain, which again is that section of your broker's platform that shows all of the expiration dates and the strikes. And they don't see that there are very logical patterns to these prices. And if you can find discrepancies in there, that can lead you to say, well, maybe the call is better, or maybe the synthetic call.
Gives you something to think about. Yeah.
Maybe the calendar spread. But this is where it helps and it pays to understand some of these relationships. So that's what we're going to talk about here.
Bill, what's the word for multiple matrices?
Matrices.
Matrices. There you go. Okay.
So here we go. What's the significance of 40%? Where's that coming from?
Kind of like mistresses. Okay.
That's a completely different thing. Here we go. At the money strike premium. Now remember, the premium is the total price you're paying for the option, will be about 40% of volatility. Now, specifically, a 1 standard deviation move. This is sometimes what we call a constant proportionality of at the money strikes. This proportion does not change, at least not a lot.
Which means
so at the money options
hold true at any level of price.
And we're going to look at some examples. So at the money options trade for about 40% of a 1 standard deviation move. So let's say if we have a $100 call, 20% volatility, what's 1 standard deviation? We take 20% of the stock price. In this case, it's an at the money, so the stock and the strike are the same. 20% of $100 is $20.
Yeah.
So we would say that we would expect that stock to trade as high as 120.
Yeah, and as low
adding
as
20, or as low as 80, but that's a 1 standard deviation move. So most of you know that under a bell curve, that would be 68% of the area. So we would say that I'm 68% confident. And
you can also, just as a little tangent here, when people talk about volatility, is it historic volatility? Is it implied volatility? Implied, of course, is talking about the options world. Historic volatility is talking about stock movement in the past. You could take a $100 stock, and over the course of a year, it goes up to 120, it goes down to 80. It had 20 up, 20 down. That's a 20% volatility move. Right. I mean, 110 to 90, assuming they're equal there, would be 10%. So that, that's where that number comes from. It's just, you talk about volatility. It's a very abstract kind of, people think it's an abstract kind of a concept, but it's really not. It's just a description of a range. That's what volatility is, a description of a range. Implied on the option side is in the future. What do we know what it is going to be in the future? We have no idea. That's why we call it implied. It's what the market is suggesting that range will be of the underlying in the future for that defined period of time.
Right. So another way to look at this is we're saying if you had 1,000 stocks just like this, that 680 of them, 68%, would fall somewhere between 80 and 120. So that doesn't mean that that's a wall, that it can't fall below that or above that. It's just saying that's where the bulk of them will fall. So that is a 1 standard deviation move, but it's important for this presentation to remember that volatility is always annualized. If we want to look at a 6-month window, we're going to do a change. We're going to talk about that. Or if we want to do a 2-year window, we're going to have to make a change.
Yeah,
but we're going to start.
You can always scale. You could scale it to the week, to the month, to the day. Right. I mean, theoretically, you could scale it to anything that you want, but you have to scale it. That, like Bill says, the volatility is always introduced as an annualized number.
Right. So we're going to assume for the first few examples that we're dealing with a 1-year option, and that's just to make the math easy. And then we'll look at some little more complicated ones. So remember that if the expiration is different from a year, whether less than or more than, we're going to have to scale it. And we'll look at examples in a little bit. But this is the basic idea of a 1 standard deviation move. So let's go ahead and take a look at some examples, Stu. Let's start off with a $50 call.
Yeah.
We have the stock at 50. It's an at the money strike. Strike is 50. Days to expiration, 360 days or 1 year. Volatility, 20%. What's a 1 standard deviation move? Well, we take the $50 call or the $50 stock price. They're the same. Remember, it's an at-the-money option. So we're going to take 50 times the volatility is $10.
$10 up, $10 down.
And then what we're going to do is multiply it by this magic number of 40%. So $10 times 40% is going to be about $4. So that's a pretty good rule of thumb. But what if we put that into a pricing model? What's it going to tell us? Well, there we go. Look over here on the left. 50 stock price, 50 strike, year to expiration, 20% volatility, no interest rates, about $4.
And Bill, just so everybody knows, this isn't some graph that you can create to put the number in that you want. This is what Bill's using here is the tool from Options Industry Council, OIC. It's an options pricing. What do they call it? Calculator. It's really a model. It's really a pricing model that that they use to just put inputs: the 50, the days to expiration, interest rate. You can put in a dividend if you want, and hit the calculate button. And it's just a model that's going to produce a value of an option at the inputs that you put in.
Yep.
Right. He's not making these numbers up. You could do it. It's the same thing.
Yep. Sometimes you'll hear people call this the theoretical value or the theoretical value. So again, as a refresher, I think we've talked about this on Coach's Corner, but the fair value means that if you were to buy hundreds of options just like this for $3.95 or sell them for $3.95, not counting commissions, you would be expected to break even in the long run. That's what it's calculating.
It's kind of the definition of fair value. Of course, it's at 20% volatility. Do we know that that's what it's going to be in the future?
Right. Technically, this number right here is what we would need to know is going to occur over the next 360 days. And that's something we don't know.
We definitely don't know.
And therein lies the whole trading dilemma. It doesn't matter what it's been in the past. Is this going to be true in the future? But now let's move to another example. And before we do, as always, for anybody who's brand new, please check us out at marketrebellion.com/get started. Lots of great videos, tutorials, training materials on there, because you definitely want to make sure you're getting trained from the right people, because there is a lot of bad information on the internet, not just with options, but pretty much anything else where you want to look. So check that out. It's all free stuff. So let's do another example.
Okay.
Let's jump it up to $100 call.
Yeah.
Now, you'd probably know, if everything else is constant, we've doubled the stock price. What's that going to do for the option?
Well,
we should double it. You should understand the math now. The stock's at 100, strikes at 100, year to expiration, volatility 20%. We have $100 stock price times 20% vol. A one standard deviation move is $20.
Remember, it was $10. And look, this can go on forever. Suppose it was $1,000 stock with an added money, right? It's just going to be 10 times. And this is a lot of the problems with pricing in people's heads is just that. Right. Oh, this option is $47. But what does that mean? Is it expensive because it's $47? Right. No, it's $1,000 stock, tool.
Right. It could be exactly proportional.
A $2 move on $1,000 stock is nothing. A $2 move on a 20 stock is something, right? You got to keep those things in perspective.
Absolutely. So now we're going to take our $20. Remember where this number came from. It's a one standard deviation move. Multiply it by our magic number of 40%. I'll show you where that comes from in a minute. We get $8. Again, roughly double of what we saw before. We put it into a pricing model, $7.91.
There's a couple pennies of slippage, compounding, etc.
There's reasons for that, exactly. Yeah. But it's going to get you close.
You're really close. You're in the game.
Right. And that's what we're trying to do, is just when you're looking through here and say, okay, this strategy should have a max gain somewhere around here, or this option should be trading for here. It keeps you from having to be completely mesmerized when I have no idea what this stuff is even about.
We're not trying to get into some quantitative algorithm where we get it to 15 different decimal places. Just get in the game.
Just get in the game. Say, okay, this should be roughly about an $8 option. And that's going to help you to understand strategies and potential max gains and losses. Now, of course, we do always want to check it on our broker's platform, like on Thinkorswim with the Analyze tab. But again, without having to shift over to that every single time you have a question, you should be able to have a reasonably good guess where these options are trading. All right, let's step it up to 30% volatility. Let's change the vol. We'll keep the stock at 100 and the strike at 100, but now we're going to go to 30% vol. What's the first step? $100 stock or strike, because again, those are equal. It's an at-the-money option.
At the monies, yeah.
Means we're going to take $100 times 30% volatility. Now a one standard deviation move is $30. We take 30 times our magical 40% number, should be somewhere around $12.
Yeah.
Go into a pricing model,
there it is.
1184.
All right, this is going to hold true no matter what numbers you push into this thing. It's going to be fairly accurate.
Right, because that's what it means if they're proportional. It's always it always remains in those proportions. You can change the shape of the bell curve by changing the standard deviation or the center by changing the stock price, but that same algorithm is going to remain proportional. Okay, so that's really what we're showing. This magic number is 40%. And again, I'll show you where that comes from. But now let's talk about scaling volatility. We start off with a few easy examples because those were 1 year. What if we had 180 days to expiration?
Yeah, this is always fun. Think of it in terms of where are we coming from, which is 1 year. Where are we going? We're trying to get to 180 days, which is half a year, right?
Yep.
So half. Go ahead. Half.
So here's what we're going to do. You have to remember that option prices are proportional to the square root of time. Don't panic. It's very easy.
Don't get caught in, it's half price. It's
exactly. Now, so you could do that with an interest rate. Yeah. If interest rates are 5%, you've got something for 6 months, then it's about 2.5%. But that doesn't work for options. And that's a mistake that a lot of people make. So what you want to do is to always figure out how much of a year we're dealing with. So even though in like that options pricing model, I showed that it was 30 days to expiration or 360, that were a little time frame. Some models will allow you to put it in terms of days, but it will behind the scenes convert it to years. So what we have to do is we have to say 180 days out of 360 is a half a year, but we can't cut it in half. Instead, we have to do what, Stu?
Square root of a half.
Take a friend of the square root, pop it into your calculator. Going to be about 71%. So now our volatility is 20%. We're going to assume the same volatility, but we have to multiply it by 71%. It's only going to, let's say, retain 71% of its power, let's call it. And that comes up to be about 14.2%. So now you can just pretend that we're dealing with a 1 year option at 14.2% volatility. The math is now exactly the same.
Yeah.
We take the $100 call, $100 times 14.2 is $14.20. Multiply it by our magic 40% number, we get about 568.
Wait, I know. The next thing you're going to show me is the pricing model at 6 months.
And that would be correct. Now we're going to go back here. We've got everything the same, except we cut the time down to 180. Yeah. And that's going to be about 560.
Yeah. These relationships are going to hold true no matter where you are, what the price is. As long as the rest of it is staying constant and you're just
at the money
time.
Assuming you're at the money, right? Don't go and do it 20 points in the money and say, hey, it all fell apart.
Yeah.
So let's do it one more here, Stu, for 30 days. Lots of people doing short-term options. We take 30 out of 360. That's about 8.3% of a year. We don't take 8.3% of our vol. We take the square root of that, which is 29%. So we take our volatility number of 20% times 29%. This is our scaling factor because we're not dealing with a full year, right? With a full year, that's just the number 1, 20% times 1. Mm-hmm. Now we're going to take 29% of it, comes up to 5.8%. Now we just pretend that we have a $100 stock with a 1 year option at 5.8% volatility. So we take the 100 times 5.8 is 580. Multiply that by our magic number of 40%, and we get about 232. And what do we have here, Stu?
232, kind of. Yeah.
Pretty close.
Yeah, pretty
Again, it's to get you close, to get you in the game. So that's one thing. But now, probably even more important, how do pricing relationships like this help you to make decisions?
So Bill, like what would you, if you went into the pricing model
Mhm.
and you saw, oh, this option is trading for 4. I mean, now what? It's like, if I see that, well, let's see. Either the vols are off from what I know,
Right.
or it's a red flag, I guess is really what I'm trying to say,
For
right?
sure.
You got to
That's where your
find
trading
the
opportunities
reason.
lie.
Why is it $4? You got to, is there a warrant attached to it, or is there this, or is that, it's like, is it a stub? Is it plus point 0.4 of some other stock? Look, you got to find out the reason.
Lawsuit, earnings. Speaking of earnings, I think we have Apple coming out here, don't we? Probably already come out.
Right.
But yeah, that could be a reason that could pump up your volatility. But now let's take another step, take that next step and say, all right, well, what are some ways we could use this? All right, so let's go have a look. And as always, before we do, please go check out marketrebellion.com/get started. Lots of great, remember, it's free. Right there on the website, help you to get started with your options trading. So at the money option prices, remember, they are priced at 40% of a 1 standard deviation move. And that is always proportional regardless of volatility or days to expiration. Because of that, because we got this bell curve that stays constant, not in terms of its shape, it can be short and wide, tall and skinny, but proportionally it stays the same. And we can therefore calculate the probability for profit. So I know, Stu, this is one of the things that you talk a lot about with students when you're coaching. It's not just about saying, oh, I think a stock is going up, let me go buy a call. That's the way that most people approach it.
Yeah.
We have to say, what are we trying to do? And which probabilities, which strategy will give me the highest probability of achieving that goal?
Or you can kind of go the other way. You could say, like, what if I understand pricing and how the world works and capitalism works with pricing, I might say, hey, I'm looking for a lower probability bet and I'm going to bet less, but I'm going to have a bigger payout. Really?
And a bigger payout.
It goes both ways, right? You could say, hey, I'm going to bet 1 to win 9, or I can bet 9 to win 1. Right. Which one do I want to do? Well, a lot of people are going to say, I want to bet 1 to win 9. Well, good luck, right? But betting 9 to win 1 means you have a really high chance of winning the 1.
Yeah, you got a 90% chance. Yeah. So the point here is that once we understand that for at the money options, that this relationship holds, okay, that's so important to understand this 40% relationship. We're paying 40% of a 1 standard deviation move. That will always hold. So it's a little bit like trying to think of an example here, Stu, like with a circle, right? If you remember from geometry, we know that the distance around the circumference divided by the diameter is pi, right? That 3.14 number. You were out that day. Well, what if you double the diameter of a circle? It still comes out to be the same. What if you make it 4 times as big? It's still the same. Those proportions do not change. And that's kind of what we're dealing with here. This 40% proportion for at the monies does not change. So let's see how we can take a little deeper dive and look at some of the probabilities. Here's our friend, the bell curve. Now, these are standard deviations across the bottom, plus up to 4 over here and minus on the left-hand side. So what we were calculating before when we did, let's say, a 20% move, that was saying that's a 1 standard deviation up and possibly a 1 standard deviation down. So that little section right in there is 68% of the area. So if we look at 1 standard deviation, the at the monies are priced at 40% of that move. And so that's going to be this little wedge right in here. So what we know from...
Not much, man.
Not much. But what we know from a bell curve is that the stock price is always over the bell curve is always over the current stock price. So that center line right there is our stock. We know that 50% of the area lies to the left and 50% to the right. Hence if you buy an at the money option, you have roughly a 50% chance of a total washout, or let's call it 1 and 2. This little segment right in here, this 0.4, is about a 16% of the area, or about 1 in 6. Now notice where it lines up, Stu, right here at 40%. That's where that's coming from. Now you can see also why it's not exact. We've got this kind of a sharp drop off in here, but for very small slices, it's roughly 40%. So you've got a 1 in 6 chance of a loss, just not a total loss. So maybe you pay 5 for the option, you sell it for 4. where you
Yeah.
sell it for 50 cents. Not a total wash,
Yeah.
but it's not a gain.
It's not measuring 100% of the dollars. It's measuring probability of a win or a gain.
Right. And so now the remaining green area is our profit. And that's going to be about a 34% or about a 1 in 3 chance. So, 2/3 of the time you should expect to lose on these guys. And that doesn't make it bad if it's priced fairly, at least according to the market. It was a reasonable bet. But what if you don't want those kind of odds against you? What if you don't want a 1 in 3 or 3 to 1 against you? Well, this is where we can start tweaking things. And we have to have a goal. We have to say, well, what are you trying to do? Do you need to buy this tail and have this unlimited gain? Well, if not, here's just one example. And I was really fighting with, I could show dozens of really cool examples, but let's just give one to give the idea. Let's look at a 95-100 vertical spread. Now, remember, the stock is at 100. So this is an at the money option, but if the expiration were right now, that would be worth $5. So again, the stock is at 100, 30 days to expiration. The 95-100 vertical, according to a pricing model, that means we're buying the 95 call and selling the 100, would be priced at 328. Now notice if the stock were right between those two at, like, say 97.5, it would be priced about 250. So the reason that we're coming up a little bit higher than 250 is because we're in the money. We've slanted the probabilities in our favor.
You already have an edge. You've already
got an edge,
right? If the end game is 5,
right,
and we're already, and we're not halfway between the 95 and the 100, we're actually at 100. Then you already have an edge going in, pricing wise, and the market's going to price that edge into a higher price.
Absolutely. Yep. So our break-even point would be 98.28. That's just the 95 strike. That's the one that you own, plus the 328 price.
So let me jump in here for 1 second and say, well, let's think about this. The stock's 100 and the market, and I make a bet to the upside, right? This is a long delta bet. I make a bet to the upside. The market actually goes against me. The stock goes the wrong way, and I don't lose any money to a point of 98.28.
Right.
Pretty cool, right?
Right. Got a $1.72 cushion. So right here is our maximum gain. There's our maximum loss, 328. That's what we paid for the vertical spread. Now remember, it doesn't mean that's what we paid for the 95 call. We could have paid $20 for this thing for all we know. It's just that that's the net. We bought the 95, we sold the 100, and that was the net cost. And so that means, because this is a 5-point spread, 95 and 100, the difference in those strikes is $1.72 is the most we could make. Now, we could go through and figure this out. Kind of a little shortcut that I like to do is to just pretend, instead of looking at the net of both of these options, just pretend that it's a call with a 98.28 strike. Even though those typically don't occur, mathematically, there's nothing wrong with it. We can say that we have a 98.28 strike call with 30 days. And if we do that, now we get this. What happened to our probability? Well, we can see this left tail has shrunk. We now have a 20% chance for a total washout. This little red area, remember, is not a total loss, but also is no profit. And so that's going to be about 18%. But look at the green. Now it's about a 62% chance.
So what, everybody, what does this mean in English? What it means is that you just increase your odds to win.
Right. Absolutely.
Right? This is the math behind increasing your odds to win, and you having to pay for it. Correct. It's not free. Market's not going to hand it to you for free. That's called an arbitrage. So this is what happens in the marketplace. The pricing is the equalizer, and the equalizer is the additional, I forget prices that you use, but it's over the 250. It's over that halfway point. And now you have a better probability, and you're paying for it, which means you're going to have a lower amount of dollars to win, lower payoff, higher probability to win. Now you be the trader. Right? Everybody out there, you be the trader. What are you looking for? Right? What is your goal? Are you looking to create a bet that has a low probability with a high payout to win? Or are you looking to bet higher? Are you looking to bet with higher probabilities to win, knowing that you're going to have to pay more for them, or something
in between?
Yeah.
If we push this even further, if we looked at the 90-95 vertical spread, it's going to be even more expensive. If we push it even more. It's going to be worth 4 and 450. If we push it far enough, it'll eventually be worth 5. It'll be so deep in the money. And the point is that this is where you, the trader, has to say, what am I trying to do? Mm-hmm. If making $1.72 on 328 allows me to accomplish my goal, but I can do that with 62% probability, why would I want to buy the call by itself, pay more money, and have only a 1 in 3 chance of making money?
Which, by the way, is 52%. Not
be a little bit above. So you have to say, that's still not bad. So this is why we always talk about, and I know you do this too with your trader students, of saying, let's start off with, what are your goals? What is it you're trying to do?
Yeah, it's how I always start with people that I just
meet.
You?
Yeah, that's good.
I just say, look, just talk to me. Tell me what you're doing. Tell me what you think what is your goal? What are you trying to do? Where are you coming from? Where are you trying to get to? And I listen. And I just, I try my best to read between the lines, and I've gotten to be pretty good at it, if I don't say so myself, over the years. I just listen to what they're trying to say, and inevitably what's missing is their goal, right? I mean, that's kind of part of my job here, right? I have to help people to figure out what their real goal is. People often say to me, well, I'm here to make money.
That's not a goal.
No kidding. Thanks, Scoop. You're here to make money. Thanks a lot. That really helps out.
Right. It's got to be measurable. It's got to be realistic. And we need to really drill down and say, what is it you want to do? And once we have that, now the problem's easier to solve.
Yeah. And
maybe unfortunately, too many times,
game. If you can achieve your goal with taking no risk, then why would you take risk?
Then why would you take risk? Exactly. If T-bills will solve the problem, do zero risk.
Do zero risk. Right. Just go buy a T-bill, right? If you have a bucket of cash and you need X amount of dollars, and the current interest rate, or, if you can lock in a 20 or 30-year bond at an interest rate that pays you what you need, why would you even think about doing this?
Right. That's actually a good rule of risk management. You should always start with the risk-free solution. And if you need to take more, take incrementally more. If interest rates are risk-free is 5% and you need 7%, well, just go to where your expected returns are 7%, not 45%.
Right. Just look for the incremental difference, not the entire 7.
Not the entire thing. And so what you're seeing here is, if this is just a supplement to your portfolio, that was over 50%. That's got to count. And yet now you've got a 62% chance of meeting that goal.
And look what happens when you stray away from that, right? You wind up taking more risk than you should be. You wind up, Mr. Murphy walks into the room, and you wind up losing more than you really were prepared to. And now you have to, I don't know what, Bill, right? You got to go back to work. You got a
monster hole to dig out of.
I'm down 10,000. I got to bet heavy this time to make my money back. And now you're down 20,000.
Kiss of death. Yep.
Endless cycle.
Yeah. Whenever they start taking more risk to try to make it back, that's the automatic kiss of death. And this is why we tell people, let's not even open that door. Let's not dig that hole. And the way we do that is to figure out what the goal is and say, what is the safest way, not guaranteed, or at least probably not guaranteed, to get there. And this is one of the things that can help you to make those decisions. So on this topic, Stu, one of my favorite quotes from Einstein, I just love this. He said, if I had an hour to solve a problem, I'd spend 55 minutes thinking about the problem and 5 minutes thinking about solutions.
Yeah, the solution part's easy. Right?
That's easy.
Right. Anybody can learn a vertical spread. Anybody can learn a diagonal. Anybody can learn the bag of strategy tricks. That's the easy part.
Yep.
Right? What are you trying to do?
What are you trying to do with it? That's the art side.
Yeah, that's the art, right? This is not all math. This is not a fire hose worth of information. This is logical, cognitive thought, trying to get from A to B. Where is B? I'm at A. How am I going to get there?
Yep. It's just that simple. But we need to know. Well, we often make the analogy, you need to program the GPS. Where are we trying to get to? And then we can tell you the most efficient path. But hopefully for everybody out there in YouTube land, it will give you a good rule of thumb, this 40% figure. There's other things we can do to kind of gauge approximate probabilities. If you're ever unsure, go to your Analyze tab. But while you're looking through those quote boards, start training yourself. What's a one standard deviation move for the at the money take 40% of it, and that should be roughly the price of the at-the-money options. And so now you know why. So Stu, let's go back and revisit our chalk talk, which we, for the first time, I think we've gave the answer at the beginning, but stock is 100, volatility 20%, interest rates 0%. What's a 1-year $100 call worth? Roughly $8, right? 40% of that one standard deviation move. Now, little side note, Stu, if you wanted to get really tricky and say interest rates are 5%, we know for a call option that it has to get tacked on.
Yeah.
That's why we made these 0 to kind of make it a little easier. But again, it's just another little piece of the algorithm that can help you to figure out roughly what that should be trading for.
And that's what the premium is. The premium is not only
volatility,
the insurance value, if you will, but it's also the cost of the money part of it.
Correct. Cost of carry for the call.
The premium, not the intrinsic value, right? A lot of people think that's part of it as well. Oh, $20 and $18 of it is in the money. Oh, well, when it decays, it's going to go to 0. No.
Right.
That's not the case.
So good. So Stu, do you have your platform up and running?
I do.
Where's Apple?
Apple is down 174.5. It's down about $3. Interestingly enough, actually 175.5 now. The straddle went out at around $6.
About $6. Yeah, I know we were talking about that. Interesting.
The actually so far has overpriced the move,
which is not uncommon for the straddle. Not uncommon.
No.
So anyway, we hope that gave you some more insights into options and where the professional traders lean towards making decisions and how to pick strategies. It's not just here, I've got a hunch that the stock's going up, let me buy a call. So if you're not getting the performance out of your options strategies that you think you should be, give us a shot. marketrebellion.com/get started. Our phone number's on there. You can even call and get coaching sessions right here with Stu. And Stu, again, thanks for making it here today.
It's always fun.
And we'll look for everybody to join us next Thursday. We want to wish you a great upcoming weekend, and we'll see you then.
Yeah. Trade the market, everyone. Don't trade your opinion. Trade the market.